The economy just posted its strongest month in almost a year. Your rent cap for 2027 just dropped to 1.9%. Both are true. Welcome to Smart Real Estate. I'm Addy Saeed, broker at Remax Gold Realty and part of the team at Westcliff. With me this week, Ribhu Rampersad, mortgage broker, CMHC and MLI specialist, and co-founder of Olympus Properties Group.
Good to be here, Addy. And a quick note before we start, everything we build at LIM is free. Head to learninvestmanage.com, sign up, and you'll get an invite to our school community to connect with other smarties. No paywall and no pay.
So 5 stories this week, and they all pull on one thread. The math on Ontario rent growth is getting squeezed. Not from one direction, from 3 directions.
Theme 1, rates are staying put. Theme 2, the rent growth ceiling is dropping. The 2027 guideline plus soft turnover rents. And theme 3, the buy side is quietly tightening, even while prices are still falling. All those 3 in your head, everything today maps back to them. So the headline number, real GDP rose 0.5% in April. That's the strongest month in almost a year and a tick above the advanced estimate. The May flash adds another 10. Both CIBC and RBC are reading the same release.
Sounds like good news. Why should a multifamily investor care?
Because a stronger economy takes pressure off the Bank of Canada to cut. CIBC is explicit. They see no rate cut for the rest of this year. So if your renewal or refinance math assumes relief is coming, this is the data that says don't bank on it. Underwrite to today's rates, which are flat.
On the transaction side, real estate agents and brokers posted their first activity increase since August, and that's last August. So the deal market is thawing a little, even as financing stays expensive. That's the tension buyers are walking into right now.
Here's the honest frame though. CIBC says the quarter was flatter. Mining and oil and gas rebounding from a weak prior month did about half the April lift, maybe a bump from World Cup spending. Strip that out and the underlying pace is softer. CIBC expects Q3 to slow.
So it's not a clean recovery.
It isn't. And the two desks don't even agree on the size of it. CIBC is tracking Q2 around 2.5% annualized. RBC is at 1.7 with upside risk. Same data and different read. When two tier 1 shops disagree, you treat the strength as contested, not settled.
So a couple of takeaways on this one. Underwrite renewals and refinances at today's rates. CIBC sees no Bank of Canada cuts this year. The April strength was concentrated and flattered by mining and oil, and one-off spending, don't extrapolate it. And there were 2 tier 1 decks disagreeing on Q2 magnitude. CIBC saying 2.5% and RBC at 1.7%. Read and treat the growth as contested. Something worth watching, Q3 GDP, if CIBC's expected slowdown shows up, the no cuts call could soften. Watch the next print before repricing any renewal assumptions. So this is the one that I'd slow down on. CMHC's midyear update splits the rental market in 2. And if you only hear rents are soft, you'll misread it. The softness is concentrated. Vacancies are highest in buildings built after 2020 and units that are near campuses. Older stabilized buildings and family-sized units, those are still tight. So it's not that the whole market is bleeding. It's the new high-end product that is bleeding.
That matters for anyone financing new supply. A lot of that post-2020 purpose-built stock was built on CMHC construction financing, MLI Select included. And CMHC says new units are taking longer to lease, in some cases months to fill a vacancy. That lease-up drag is a real risk on newer deals.
Then there is the incentive war. CMHC says operators are increasingly leaning on incentives and lowering asking rents, and those incentives have intensified over the past 6 months, reaching as high as several months of free rent. From the operations side at Westcliff Living, that's the number that matters. Your face rent can hold at a headline figure, while your effective rent, which actually hits the bank after 2 months free, drops hard.
So when you underwrite an acquisition of a rental, you're asking, is that a real rent or a rent propped up by concessions that reset next renewal?
Exactly. Now, the one piece of relief, CMHC notes competition from investor-owned rental condos is slowing absorption, and they expect that to fade as condo completions fall sharply. But that's a projection, not a fact. If you own new lease-up product today, that relief is a year or 2 out. You're bleeding concessions right now.
That's the bear case in one line. It gets better later, doesn't pay this year's debt service.
So a couple of key takeaways. Not all multifamily is soft. The pain is concentrated in post-2020. High-end and near-campus product, older stabilized and family-side stock, it stays tight. Underwrite effective rents, not face rents. Incentives up to several months of free rent are masking real rent declines. And new lease-up carries genuine absorption risk. Stabilized older buildings are the defensible position right now. So something worth watching. Condo completion pipeline. CMHC's relief thesis depends on condo supply falling. If completions stay elevated, absorption stays low. Track it before pricing in the recovery. So RBC says national housing affordability just hit a 4-year best, and Toronto is improving faster than most markets. Most people read that as bullish. for a landlord, read it the other way.
So the mechanics. Toronto condos are nearly back to pre-pandemic ownership affordability. Around 36% of income on RBC's condo measure. But one flag, RBC's own Toronto page prints a couple of different condo figures. So we're using the number from that summary table and leaving the noisy one alone.
And here's the landlord read. When condos get affordable to own, they compete with your rental unit. The detached buyer isn't going anywhere. Detached still eats more than 80% of income in Toronto, but the condo renter now has a real ownership alternative. And RBC says asking rents are falling, with Toronto leading on population contraction and soft demand.
Counterpoints, to be fair to the bulls, RBC also says the affordable gains are tapering. Price declines is slowing and they don't see more Bank of Canada cuts. So the ownership relief may be near an end. That doesn't help your rents in the near term, but it is the demand side headwind landing right as the rent cap drops. So a few key takeaways. Proving condo ownership competes directly with condo rentals, and the marginal renter gains an exit. Detached stays unaffordable, 80+% of income, and that renter isn't leaving the pool. Condo renter might. Falling asking rents and tapering affordability equals a demand side squeeze into a 1.9% cap year. And something worth watching, population data. RBC ties the rent softness to population contraction. Migration reaccelerates, the demand reflips, to watch the quarterly numbers. Everything we build is free. Sign up at learninvestmanage.com, get the tools, and get your invite to the school community to connect with other smarties.
Ontario's 2027 rent increase guideline is set at 1.9%, down from 2.1% last year. That's the maximum on most rent control units without an above guideline order. And we verified this against the government's own page. It's real.
For underwriting, the numbers matter less than the mechanics. The 1.9 capped in place growth on units first occupied on or before November 15, 2018. It does not apply on turnover. Vacancy resets the market, and post-2018 stock is exempt entirely.
So the flexibility lives in two places, turnover and newer buildings. That's where your rent growth actually is.
Right. But connected back to the CMHC segment, turnover rents is softening. So the escape valve on a capped unit itself is narrowing. 18 months ago, betting on turnover to outrun the cap was a strong plan. Today, it's a weaker one because the market rent you'd reset to has come down.
On accuracy note, the numbers confirmed, but we're not going to state the announcement date on air. We couldn't independently verify it against the dated government release, so we're attributing the figure to ontario.ca page and leaving the date out. Couple of takeaways. 1.9% caps in place growth on pre-November 2018 rent-controlled units. Turnover and post-2018 stock are exempt. The turnover escape valve is narrowing as market/turnover rents soften. The exemptions matter less than they did 18 months ago. And model 1.9% into 2027 in place holds. Don't assume turnover fully offsets it. Something worth watching, the gap between the 1.9% guideline and actual turnover rent changes. That spread is the real signal for controlled unit strategy. This one I pulled apart from the actual report, not the press release. And when you go into the price index tables, it tells a sharper story than the sales up and prices down narrative. So let's start with the paradox. Condo apartment sales in June up 14.3% year over year, the biggest jump of any home type. Buyers are piling into condos.
But the price index is falling fastest right there. And I want to be precise. Index, not the average. The average is mix sensitive. HPI holds quality and mix constant. On the HPI, apartments are down 8.2% year over year. Detached, down 5.3%. The apartment segment is leading the entire correction.
And it's not just the aggregate. I went municipality by municipality in the report. In almost every one, the apartment decline is steeper than the market's overall composite. Brampton is a standout. Apartment benchmark down almost 17%, while Brampton's overall market is down just under 7%. Condos there are dropping about 10 points faster than anywhere else. In Mississauga, my market, apartments are down 8.7% versus a composite of 6%. And in the city, Toronto's W01 condos down 16.6%.
And here's the part that breaks the market stabilizing story. There are Toronto wards where the overall index is actually flat or slightly positive, detached holding up in the wealthy pockets. But even there, the apartment segment is still negative, down 12% in some of them. And wherever detached holds, condos still fall.
So when you hear GTA prices are bottoming, that's a detached story. It's not a condo story.
And now connected back to the CMHC segment. Those same investor-owned condos are the shadow rental supply flooding the market. So the condo owners squeezed on both exits at once, soft retail and soft rent. That's who keeps cutting.
And that caps our rents. A distressed condo landlord covering a 6% mortgage will undercut you to fill the unit. For a purpose-built owner, that shadow supply is your real competition. And right now, it's very motivated. So a couple of key takeaways. So condo sales are up 14.3% year over year, yet apartments lead the mix-adjusted price decline. HPI is negative 8.2% versus detached negative 5.3%. Buyers are chasing a segment still repricing and not calling a bottom. The weakness is broadside, not an aggregate artifact. An apartment HPI falls faster than the local composite in nearly every municipality. Brampton, minus 16.9. Mississauga, minus 8.7. Toronto, W1, 16.6% minus. GTA stabilizing is a detached property story. Apartments are staying negative even in wards where the overall index is flat or up. Examples, Toronto C10 composite plus 2%, apartments minus 4.4%. Something worth watching, condo listing volumes, so distressed investor owners squeezed on both sides of the resale and rent, are the marginal price setters in the GTA rents. That's the tell for rent pressures in purpose-built properties. So let's pull the three threads together. Number one, rates aren't rescuing your refinance, underwrite flat. Number two, the 1.9% cap plus soft turnover rents means rent growth is compressed on both ends. And number three, the condo paradox, sales are rising, but apartment prices are leading the declines board wide. Buyers are chasing cheap, not calling a bottom.
And where's the room? Turnover in US stock. Even that valve is narrowing as market rents soften. The takeaway isn't panic, it's tighten your assumptions. The deals that pencil in this market are underwritten on today's rents and today's rates, not on a recovery that hasn't arrived.
So for a couple of takeaways on this episode, underwrite renewals and refinances flat. No Bank of Canada cuts expected this year. Rent growth is squeezed from both ends, 1.9% capped on controlled or rent-controlled units or existing tenants, softer turnover rents on any exemptions, and the condo paradox where sales are rising but apartment prices lead the declines in nearly every municipality. A segment still repricing, it's not at the bottom. Take a defensive posture, stabilize older stock, scrutinize effective rents, and lease up risk on newer product. So that's the episode, Smarties. All the tools are free. LearnInvestManage.com. Sign up and join us in the school community. We'll see you next week. Addy Saeed is a licensed real estate broker with Remax Gold Realty, RICO license number 4735346, founder and general manager of Westcliff Living, and an OSC registered dealing rep. Ribhu Rampersad is a licensed mortgage agent level 2 with BLD Financial, DLC license 12360. The host may reference companies or entities in which they hold ownership or financial interest, including Westcliff Asset Management, Westcliff Living, Olympus Properties Group. Listeners should be aware of these relationships when evaluating any commentary in this episode.
This podcast is for informational and educational purposes only. Nothing in this episode constitutes financial, legal, mortgage, or investment advice. Always conduct your own due diligence and consult qualified professionals before making any investment decision. Past performance is not indicative of future results.
Take care, Smarties.